investors, welcome to Bullsmart Academy. Today we are delving into the world of finance to unravel the mystery of hybrid funds. Whether you're a seasoned investor or just stepping into the market, understanding these funds is crucial as they could open new investment opportunities. Stick around as we break down what they are, their types, and how they can work for you. Let's get started. Hybrid funds bridge the gap between risk and stability. Are you one of those investors who finds it hard to stick with one risk profile, especially if you're not entirely a risk taker or a risk-averse investor? That's where hybrid funds step in, offering a blend of high-risk and low-risk assets. Hybrid mutual funds are a category of mutual funds that invest in more than just one asset class. Most often, they are a combination of equity and debt assets. Each hybrid fund has a different combination of equity and debt targeted at different types of investors. However, these funds may not necessarily be limited to these asset classes, as some also invest in asset classes like real estate and gold. So, why do hybrid funds invest in so many asset classes, and how do they operate? Think of hybrid funds as an investment manager creating a financial symphony. Their main goal is to strike a balance, providing regular income along with long-term capital appreciation. The allocation to each asset class is finely tuned by the fund manager based on the fund's objectives and market conditions. Now the big question, should you consider investing in hybrid funds? Understanding the risk profile of hybrid funds is key. Hybrid funds are deemed riskier than debt funds but safer than equity funds. This sweet spot makes them the preferred choice for many low-risk investors. For newcomers testing the waters, hybrid funds are said to be ideal as they allow you to benefit from equity investments while mitigating market volatility through debt. Now, let's take a look at different types of hybrid funds. Firstly, we have the multi-asset allocation fund. These types of funds have been mandated by SEBI to invest in at least 3 asset classes with at least 10% invested in each of the asset classes, providing investors exposure to a diverse range of investments, giving investors the benefit of diversification to survive different market conditions and at the same time promoting long-term capital appreciation with reduced risk. If you want to learn more about multi-asset allocation funds, consider checking out our detailed video which focuses on explaining exactly what multi-asset allocation funds are. Next up, we delve into the world of conservative or debt-oriented hybrid funds. These schemes invest 10 to 40% in equity and allocate the remaining portion to debt instruments. The aim is to generate income from the debt component while giving an added boost to overall returns from equity investments. Following that, we encounter the aggressive hybrid fund or equity-oriented fund. These schemes invest a minimum of 65% and a maximum of 80% in equities, with 20 to 35% in debt asset classes. The goal here is to deliver higher returns with reduced risk thanks to the debt investments. Yes, the world of hybrid funds is pretty huge. Now, let's explore the balanced funds, also known as dynamic asset allocation funds. Truly dynamic, these schemes can swing between focusing on debt and focusing on equity depending on market conditions. Their allocation to different asset classes keeps changing depending on market conditions, and they are known to be great investments in bearish markets or in time of recession. Last but certainly not least, we uncover the mystery of arbitrage funds. Acting as financial detectives, these funds buy low in one market and sell higher in another, maximizing returns through derivative instruments. However, arbitrage opportunities do not always arise, and in these situations, they pivot to debt securities and cash. Suitable for low-risk investors aiming for debt-like returns with tax implications similar to equity funds. Now that you have an understanding of these types, let's dive into the perks. Hybrid funds offer diverse advantages based on their types, including access to multiple fund classes, active portfolio and risk management, diversification, and options catering to different risk profiles. If you found hybrid funds intriguing and are considering investing, ensure that you understand the fund's risk profile, past returns, your investment horizon, the fund's management, and its investment strategy before investing. Each type of fund comes with its own set of advantages, making them a versatile choice for investors. If this deep dive into hybrid funds has piqued your interest, let us know in the comments below which fund you would like us to cover next. Happy investing!
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.